This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, it is Wednesday, March 11th, and this is Radio Free Wall Street. You know, it occurred to me this week as I was studying some of the economic data, the financial data, the liquidity data, and watching the market, that the monetary policy transmission mechanisms are showing signs of beginning to break. Of course, the Fed hasn't been printing outright for 5 or 6 months now, but the Bank of Japan has been. And just this week, the European Central Bank picked up the cudgel and they begin to buy outright government securities and other securities. We won't know exactly how much yet for a few more days. They're going to report on a weekly basis. And we're going to see the size of the changes that occur in their balance sheet as time goes on. Right now, we're kind of in the dark, but it's pretty clear that whatever liquidity they have injected into the market since their first operation on Monday hasn't reached the U.S. markets yet. The treasuries have bounced a little bit, but of course stocks have gotten clobbered. So I'm going to take a look at a couple of charts today and go over them with you that suggest that maybe the transmission mechanism between monetary policy and economic activity, if there is any cause and effect relationship, which I doubt, but we're going to look for signs that maybe correlations that had existed are breaking. Keynesians and the Wall Street economists would have you believe that the Fed can take responsibility for driving economic growth and that QE has played a role in that. I don't buy that. I think the economy probably would have recovered on its own without these excessive and extreme measures. It has always done so in the past. What drives economic activity and real growth is productivity, population growth, the very basics of that, and demographics. As long as population is growing and people are getting an education and their incomes are increasing, then the economy should grow. But printing money is not a stimulant for those activities. The fact that they move in tandem is notable, but there are indications that that tandem movement is starting to come apart. Yesterday, I wrote a free report on the JOLTS survey, the Job Openings and Labor Turnover survey. That is Janet Yellen's supposedly one of her most important indicators. And the mainstream media was all excited about the fact that the number of job openings was increasing and that they were at record levels and that this is supposedly bullish. But I went behind the numbers. And that article is still posted on the front page of the Wall Street Examiner. You can look at that. And you can see on this chart that, the growth rate of job openings is skyrocketing. But at the same time, when we look at the number of people hired versus the number of job openings, that's now at an all-time low. Businesses cannot find workers to find the job openings. When I looked at the data, it was clear that there are two reasons for that. Number one, most of the openings are in the lowest paid sectors, but also there are a couple of threads that run through this data. Perhaps the most important is that there are sectors that are showing fewer job openings, and they tell us a lot about what's going on inside the U.S. economy. One of the biggest declines in job openings came in the mining and logging sector, which of course includes oil and gas extraction. Mining and logging, construction, transportation, warehousing, and utilities, as well as information, are all core economic activities. And the fact is that there are fewer openings in these areas than there were a year ago. So that's an indication of slowing in some of these base productive activities of the U.S. economy. I think that's a serious problem that is beneath the surface that nobody's talking about. Arts, entertainment, and recreation. Huge cutback, 46% decline in the number of job openings between this January and January of 2014. Culture vultures are always the first to see cuts whenever business starts to get a little bit tight. They're less likely to support these organizations, and as a result, they have to go through cutback. The fact there are fewer job openings in this area is another sign that beneath the surface, beneath the rosy facade, there are cracks in the foundation. Finance and insurance. Some bloom is coming off the financial bubble, the financial engineering bubble. And finally, leisure and hospitality has been one of the strongest growth areas. That's basically your hotels and restaurants, and they serve mostly upper middle income and upper income consumers, down 5% year to year. So there's a sign of slowing in that area too. The areas that service the 1% or the 10% are showing some signs of a slowing. This does not show up in the total number of job offerings, which are growing at a radically high rate. And most importantly, they're at the same level in terms of the number of job openings per million of population. They are at the same level that they reached at the top of the housing bubble in 2006 and 7. And in fact, they are at the same level they reached after the housing bubble topped out. Employers follow the stock market for their cues about what to do next in many cases. The stock market is often the last to get the news when there are problems. So these indications that we're at record levels of job openings could be a sign that the bubble has already gone over the top. In particular, when we look at the collapse in the energy sector and prices there and the beginnings of cutbacks in that area, that's very much analogous to what happened at the top of the housing bubble. The cuts didn't come until after prices had topped out. A couple other charts that I looked at today that I have not published yet.